All right. Well, good evening, everybody. We are super excited to welcome you to our third webinar series. And we are even more excited to welcome Mr. Lipetsky from the Colorado Department of Ag. He is the Markets Director, and he's really excited to share a COVID update and what this new normal world we're finding ourselves in will be like. So I'll let you take it away.
Okay, I'm going to try to share my screen here. And
Perfect. Let me stop sharing for you really fast. There we go. Okay. And Tom, if you want to introduce yourself a little bit more too, that one was an on-the-fly introduction.
Well, thank you, Michaela. And I think, all of you are very lucky to have Michaela working for you and Amber. Michaela and I got to meet when she was with the FFA organization. And, last summer she worked for Senator Gardner and gave me one of the best tours of the Capitol that I think I've ever had. So very fortunate to have her working with all of you. And, just by way of introduction, again, I worked for the Department of Agriculture, worked with the Markets Division for the last 12 years, heading up the markets programs. And prior to that, spent some time with the U.S. Potato Board and the U.S. Meat Export Federation, as well as a couple of years with USDA in Washington, D.C. So had the opportunity to work for state departments of agriculture, USDA, and industry as well. So kind of a mixed bag background, but I grew up in North Dakota, lived on a farm, grew up on our farm there, and continued to be involved in managing some of our farm operations there. Mostly today it's about managing tenants, young farmers, as none of us children decided to go back to the farm. But in any event, it's been a fun ride for me. Enjoy agriculture. It's kind of in my blood, and really look forward to just spending a little time with you this evening talking about what's going on in markets. Because I remember being with all of you at your annual meeting in early March, and probably to say the least, a lot has happened since then. And, the COVID, the whole thing that's been going on in the pandemic has pretty much rocked our world since about that time. It's turned everything upside down. We've stayed home, we've isolated with our families. A lot of us are teleworking, and those that aren't teleworking have a whole new regimen of procedures and processes they need to be following these days. Checking their temperatures, health monitoring, masks, all those type of things. And we're doing a lot more social distancing, as we all know as well. And certainly most of the non-essential travel that many of us might have been doing has come to a screeching halt as well since early March. So we're certainly not in the normal that we had become accustomed to up until about the time of your annual meeting. So I don't know if there's a connection there or not, but that's kind of where I draw the line these days. It was like everything before that was normal, and then everything after that became not so normal. But there have been huge shifts in our retail and food service environments. Today we're buying almost more of our food at retail than we ever have before. And initially, that really kind of messed up the supply chains as suppliers had to adjust from this mix of food service to more just retail. And in doing that, we saw some empty shelves, products out of stock. We saw limits on purchases. First time I think I'd ever seen somebody say you can only buy 2 pounds of hamburger. And a lot of that wasn't necessarily because of, food shortages. It was mostly panic buying that had created this sense of a shortage out there. And since that time, food service operators have had to pivot to deal with less in-restaurant dining capacity. They've had to ramp up takeout, curbside pickup, or in some cases, home delivery type options. And we've also, since that time, experienced a continued intensification of kind of this trend toward buying more local product. And we've really seen that around the meats. A lot of the direct-to-consumer beef producers, poultry producers, their business has skyrocketed. And certainly around some of the CSAs or community supported ag programs with fruits and vegetables as well. We've just seen a continued intensification around that local food buying. Another change we've seen, oil prices, if even only temporarily, dropped below zero. And you might think, hey, that sounds great for everybody in agriculture, unless you're a corn producer. You know, that sudden drop in oil prices made ethanol far less competitive and really crunched our corn growers. So again, something that sounds really good had some unintended consequences. We've had a lot of supply chain disruptions and market shocks. You know, across the US, we've seen some vegetables being left unharvested, sometimes for lack of demand, other times lack of workers. We've seen hogs being euthanized in other states, and certainly our beef markets went into free fall when we had some temporary closures of some of the large meat packing facilities. And the last item that's happened since we last talked is just we've seen kind of an unprecedented levels of government support flowing in to help support farmers and ranchers. But still, you know, there's a lot going on and keeping our farmers and ranchers up at night, and that's kind of what I've been asked to speak about this evening. So let's kind of jump into that. But boy, a lot has happened since we were together last. So tonight I just want to talk just really quickly about our response at CDA, what we had done when this whole crisis came about, a little bit of the current sentiment kind of around agriculture, and then some market trends, a little bit more about government spending, farm income, and then take any questions that you might have. So we'll keep kind of moving through this. Now, as a department, when COVID came about, you know, really a shock to our system in terms of how we operate as an organization. And we moved fairly quickly to kind of a telework operation, but yet recognizing we have about 120 some people that are field inspectors, our brand inspectors, our fruit and vegetable inspectors, a lot of people out in the country that needed to be out doing their job every day to continue to do what industry expects of us. And so we had to pivot pretty hard and pretty fast to get telework set up. And I've been very pleased and surprised that it's worked as well as it has, to have most of our team working from home, except for those that are in the laboratories and those that are field services. And we've really continued to maintain all those programs and the services that we had before. You know, veterinary services, our laboratories, our brand inspection, phyto certificates, all those things have never missed a beat. And that's something I think as an organization we can all look at and say we've done a pretty good job in this changing environment. But with the advent of COVID, we also had a lot of other things come into play. We've had a couple people play very key roles in the State Emergency Operations Center. One of those really leading what we call ESF 11, which relates to emergencies around agriculture and natural resources. And we've also played a key role in ESF 6, which deals with mass care, which is primarily like food banks, again, very important for agriculture. And those roles are really important in terms of coordination between emergency operations and helping to set some of the policy that gets driven out of these emergencies. Internally, we stood up a couple different task forces, one to deal with supply chain issues that I headed up, and another to deal with recovery issues. And we really helped to support the Governor's Economic Recovery and Growth Council. That was headed up by former Secretary Pena. And one of the key roles that we've also played is just that coordination between industry and the governor's office relating to public health orders. You know, for example, you know, our wineries were really struggling with how they could get reopened under some of the public health orders. And so the department played a key role in that coordination between the wine industry and the governor's office, and did so with farmers markets and a whole host of other industries as well. So that coordination role was really important. But some of the things that, at least in my markets group, that I'm really proud of is we really, you know, took advantage of some of this new environment and came up with some new strategies. A couple things we launched was a new website, coloradoproud.com. Colorado Proud's been our program to promote locally for years. And but we saw this huge influx of questions from consumers about where could they find meat products from a local beef producers? Where could they find local products? And so we quickly stood up a website to connect buyers and these companies that wanted to be supplying consumers more directly. And you might also think about, the world we live in, trying to promote internationally. That came to a screeching halt in all this as well. But yeah, we've developed a lot of key contacts and buyers from countries around the world. So what we did was very quickly was put together another website, Colorado Food and Drink Exports, that we could then pitch out to all these buyers that we've been working with over the years to keep companies and products in front of them without having to travel for trade shows and other things. So not just our markets division, but everywhere across the department, we had kind of this rapid response. We pivoted, and I think we're doing and living up to our mission of supporting agriculture. When I think about kind of the sentiment surrounding ag today, there are really three sources I kind of go to on a regular basis. One of those is the Creighton University Rural Main Street Index. And this is a monthly survey of bankers across the Midwest. And what I just kind of want to draw your attention to is the red line on the graph. You can kind of see in December, January, February, the rating was over 50, and 50 is kind of considered neutral in this survey. And then with April, it fell to 11 or 12. And in May, it fell to like 9. So the sentiment of our banking community toward the farm and rural economy really tanked with COVID. They saw, price collapses. They were worried about repayment of loans. And we've seen a little bit of an uptick in this sentiment here in May and June, but we're still, way off even being at neutral. And what I thought was interesting is in the last survey, 1/3 of the bankers that have ethanol in their districts reported that those facilities had either shut down or were running at really production lows. Farmland prices, sentiment wasn't quite as bad, but again, certainly this is kind of the sentiment that's been out there around agriculture, but recovering. Another measure I kind of look to on a monthly basis is the Purdue University and Chicago Mercantile Exchange Ag Barometer. And this one's a little different. This one surveys 400 ag producers every month. And those producers are all, what I would consider commercial type ag producers, 500,000 or more in cash receipts, and pretty representative of kind of that commercial part of our ag industry. You can see here too, as we get to that February, that high, that was the highest recorded sentiment in this survey since they began. So I think in February, the producers were seeing a new trade deal with China. They were going into a new season. They were optimistic. And boy, you can see how that quickly changed with the advent of COVID in March and April. We've seen a little bit of an uptick here, but still well off the kind of just even an average index of producers kind of thinking about their expectations for the future. A couple things that came out of the last report too, and this is probably no surprise to any of you, 4 out of 10 report doing more business online, but almost half said they're less likely to attend an in-person meeting or conference. So what you're doing with these webinars fits right into that sentiment. Last kind of measure I watch fairly regularly is the stock price of a company based in Denver called Farmland Partners. They're a REIT that owns farmland in 16 states. And that's their entire business, farmland ownership. And I think if you look at this graph, you can see the last 2 years, their stock price has been pretty darn flat. And I think that's probably an indication of what they see or what the market sees in terms of profitability or returns to landowners. So I kind of use these three measures as kind of a barometer of what's going on in agriculture. And it kind of gives me a little bit of a snapshot into banking community, producers, and maybe just what's going on for landowners out there. The thing that I know they're all looking at and what's driving all of them is profitability for our farmers and ranchers. And what I'm showing here is just cash receipts for Colorado's top 5 ag commodities. Cattle and calves is what really drives Colorado's ag economy. It's half of our cash receipts, and then followed by dairy, corn, hay, and wheat. So, if you look at these five, that's a pretty good indicator of the health of Colorado's ag industry. And like I said, the cattle and calves, 3.5 billion of our 7 billion in cash receipts. But there's been a lot going on with these commodities over the last 5 or 6 months, and let's just kind of take a quick snapshot look at some of that, and maybe there will be some insights for you in that. As we look at slaughter cattle, and I'm looking mostly here at the Mercantile Exchange futures prices, and this has been a very volatile market over the last 12 months. We saw prices start to fall maybe in like February and into March as food service demand started to fall off, and a lot of that was international before it even got to the United States. Then that big green circle, that represents when JBS and Cargill and other meat processors across the U.S. had some health issues with workers and had to shut down temporarily. It just put our markets into a free fall. And we started to see some price recovery as they got back online and had a little bit of demand. But then we saw a big price drop here again as we got into June. And, some of that was just backlog of cattle waiting to be processed. Even though the processors were back up and running, maybe it was 80%, and we just had more cattle coming through the feedlots, and it got our prices down to decade lows. We started getting down into the 90s, $90 a hundred, and certainly been a rocky time for our cattle producers. Been a little bit of an uptick in the last few weeks. Some of that's just a reflection of fewer cattle being placed in feedlots this spring and starting to create some balance back in our markets. A pretty rocky road for our cattle producers. On the milk side, for our dairy producers, you can kind of see that March, April time period where prices began to really slide. A lot of that was just driven by the fact that, the milk companies and milk processors were used to putting a lot of milk in those small little milk cartons that go to schools. They were used to some of the big food service and institutional milk supply, and pretty soon they had to put all their milk into the containers that go to retail. So it was like trying to change all the volume that would normally run through 2 processing lines through 1 processing line. And we just had some buildup of milk supply, and it just tanked the milk prices. But shortly after that, they kind of got their act together, figured out how to run more retail volume through their facilities. And dairy producers culled a few cattle, and they took a few supply measures, and lo and behold, the government started buying dairy products to go into some of the food banks and school programs again. And so we saw prices kind of skyrocket on dairy producers, only to kind of fall back to more normal trends now again as well. And we talked a little bit about corn earlier. Just seeing that huge drop in corn prices around the time when we started to not drive as much. It doesn't help that our corn industry has huge carryover stocks right now. That's driving prices down too. But there's about almost 40% of the corn in the United States is used for ethanol. And as suddenly we saw oil prices tumble and we weren't driving as much, that really had an impact on those ethanol prices, and corn prices followed along with it. That last little circle on the far right, you probably heard of the derechos that went through the Midwest this last week. It really messed up a lot of the corn crop in Iowa. There's some estimates that, about 20 to 30% of the corn crop has been damaged in Iowa. And so that price spike we're seeing out there at the end is the markets reacting to the impact of those, gale force winds that blew through the Midwest and knocked down, grain storage, damaged crops, and all kinds of damage done across the Midwest. Here again, just demonstrating that ethanol price, plummet that happened when suddenly we weren't driving as much. We're getting a few more cars back on the roads, and if you're around Denver, you'd swear that we're back to normal. It's bumper to bumper some days, but our corn guys are seeing a little bit more uptick in demand for ethanol. But still, we've got some plants that are running very low capacity if they haven't shut down at all. And one of the key issues here too that's kind of antagonizing a bit for our corn industry is EPA continues to grant an increasing number of waivers to some of the small refineries to exempt them from the renewable fuel standards that require a mix of certain ethanol in their blends. And right now what the corn growers need is more demand, not less. And having all those refiners living up to the renewable fuel standard is something that the corn industry is really eager to push right now. Alfalfa and hay, prices, they're doing pretty steady. The dairy industry, horse owners keep that market pretty steady. Probably going to see some uptick here as the entire state of Colorado is considered in drought right now. So, hay is going to be a little bit tighter to come by and prices might spike up a little bit from where they are today. But overall, not as much of a shock to hay producers as some of the other commodities. And the last one I just want to touch base on is wheat. And you can kind of see that spike back in about the March area. And that was where, a lot of the industry was suffering a little bit from lack of international customers that had slowed down. China being kind of a larger wheat buyer. With COVID, some of those prices kind of slacked off, as did their imports. But this big spike we see here in about mid-March and April, kind of a funny thing happened across the United States. Everybody started baking again. And with that baking was a big spike in flour demand. Maybe you saw some of the flour shelves in the stores being almost empty. But that was kind of a nice little run up in prices for our wheat producers until the flour millers kind of kept up with demand and met that demand. And now prices have kind of continued to trend downward, mostly just on large world stocks of wheat. The other component in this is exports. And U.S. exports, or if you kind of see those bars on the left, are trending down a little bit year over year from last year, looking at January through June. Probably, not too much difference with Canada, not a lot with Mexico or Japan, but China is where we're probably seeing some of the more decrease over the last couple of years. And hopefully that's going to change. We've got this new agreement with China, right? And, so as we think about international and ag, China is the country that comes to mind. So I took a look here at January through June exports from the U.S. to China. And we're, just a little bit above where we were a year ago, but well below where we were in 2018, about the time this all started. And the big difference here is, China is still not buying a lot of soybeans. And that's where I've got this red circle. And a lot of concern around that because, if China doesn't step up some of the soybean purchases, they'll probably not meet the commitments that they committed to in the phase one agreement, which is substantially higher than the 2018 level. So a lot of interest out there watching what China's doing. They made a huge purchase today of sorghum. That's going to help the sorghum producers a little bit over the next couple months, but a lot of concern about China and getting these exports back on track. And that's really one of the keys for Colorado as well. If we think about Colorado food and ag exports, we've had a pretty good run over the last decade. You can kind of see on the left that our exports have almost doubled over the last decade, from about $1 billion a year to almost $2 billion a year. And, we've got some pretty key markets in this, Canada and Mexico, as you would expect, our neighbors to the north and south. But South Korea has really turned out to be a really growing market for Colorado over the last several years, and very much a key market for us. China, not as much, but certainly could be if we can get some of the beef exports ramped up and do a little bit more with corn as well. When we talk about Colorado exports, we've got to think about beef. That's our biggest export. No surprise. But here are exports, about $1.2 billion worth of beef leaving Colorado every year for export markets. So it's almost 2/3 of our exports is beef related. And it had traditionally been, Canada and Mexico. But what's interesting, if you can see the graph with South Korea, over about the last 4 or 5 years, much in thanks to the Korea Free Trade Agreement, Korea has now become Colorado's #1 customer for beef. Kind of a big change of pace. but certainly that growth has been instrumental and helpful to our producers. Colorado ag exports first 6 months of the year trending a little bit lower as well, but mostly related to some fallback in China as well. Let's talk just a little bit about farm program spending. And if you know farmers and ranchers, I think you would probably agree that every one of them would rather get their revenue out of the market rather than a check from the government. But the last couple of years, these government payments and farm program payments are often the difference between them losing money and maybe eking out a small profit while we work through some of these trade adjustments and market situations. And you can kind of see it back in FY 17-18, and for a number of years leading up to this, government spending on farm programs have been about $20 billion a year. Last year it jumped up to about 35 billion. A lot of that because of the market facilitation payments to deal with helping producers through the China mess. And then this year, we still have some market facilitation payments. That green box being 16 billion that came through the coronavirus food assistance program. That's going to put ag spending this year for farm programs at around $50 billion. One of the big questions as we look forward is what happens next year. There was likely no market facilitation program payments, likely no more coronavirus payments. So we could see a lot of revenue a loss out of the income stream of farmers and ranchers. And that's something that poses a big concern. USDA does a pretty darn good job of keeping a dashboard. And of that 16 billion in coronavirus payments, I think the number that's been spent so far is about 7 billion, with 110 million of that coming to Colorado at this point. Doesn't seem like quite the right proportions, but I know we've got a lot of applications still in the mix. That's about 5,000 different payments that have been made to producers across Colorado, about 70-some million of that to livestock, 20-some million for dairy producers. And I think we'll see a lot more coming from corn producers and wheat producers in the months ahead. And USDA also just recently opened this up to some other commodities too, more specialty crops, potatoes. And so I anticipate we'll see those numbers go up, as I know USDA is trying to do what it can to get these dollars out into farm and ranch country. Well, how does all this hit the bottom line? There's an organization called the Food and Ag Policy Research Institute, FAPRI, that does a lot of work on farm income numbers. They just came out in June with their revised numbers based on what's going on with COVID at this point. They're kind of looking at 2020 income levels across the U.S. to be about on par with 2019. But the key part to recognize is out of the 90 billion in farm income, about 30 billion of that is coming from the government. So kind of a big issue there. And they really project that going forward, the issue is probably not going to be so much this year, but next year, when we still have low commodity prices and government support falls off, we could easily see farm income drop by 10 to 12% next year, unless there's some reinstitution of some of the farm payments. And if we carry that over to Colorado, just apply those same percentages, here too, farm income for Colorado is off compared to some of the highs. We had a record high income of 1.8 billion in 2011, another great year, 2015, about 1.6 billion. And this year we're probably going to be somewhere between that 1.2 to 1.4. And if we see another drop next year, we're getting close to that lower end of the average farm income across the state over the last decade. So we're looking at some problems with in our farm community that way. There's clearly kind of a trickle down from what happens on the farm and ranch to what happens on Main Street. And, last year we did some work to look at what the farm economy kind of generates in economic activity. And we found that Colorado's ag industry helps contribute about $47 billion of economic activity to the state's economy. That's inputs, production, processing, transportation, everything that kind of gets it to the retail store or to the restaurant, and help support about 5% of the state's workforce. Pretty big numbers for what ag supports. But as I kind of hear these numbers and look at farm income and price points, where we're going to be with revenues, as we get to where we can start to look at 2020, my guess is the ag contribution to our economy is going to be quite a bit less than it was this past year. So kind of what's my take on all this, and you're probably tired of hearing me, so I'm going to wrap things up here pretty quickly. But, certainly I think you can see there's a lot of uncertainty in our markets today. Certainly we think our farmers and ranchers are going to make it through 2020. But boy, thanks to a large influx of government payments to kind of help smooth out the pitfalls that we're running into today, those government payments might be about 1/3 of the farm income. And I think, as I kind of see it, we're probably facing a pretty tough year next year, unless something happens with, market prices. But we've got corn, wheat, and everybody's got big world supplies. So it's unlikely that that's probably going to be the case. And we've got to be concerned about what the political motivation will be to continue these type of payments once we get through this fall's election. As we know, sometimes politicians like to buy farm votes, and they've been doing a pretty good job of it the last, with these CFAP payments. And then there's the part of our farmers and ranchers, not making a lot of investments these days, not buying a lot of new tractors, not buying a lot of new farm equipment. That all has kind of a ripple effect on equipment dealers, farm supply dealers in our rural communities, and I'm worried about that. Our rural communities need everything they can get to stay afloat, and hopefully, we can weather through this for them as well. If there's some good news out there, and I say if there is, I feel like a real pessimist these days around ag, even though I'm involved with it, and I still see a great future in it for everybody. If there's some good news, we've got some of the lowest interest rates on record right now. And maybe there'll be some opportunities for our producers to refinance some of their longer term debt, or refinance some of their short-term debt at some of these low interest rates that might help them out in the long run. And I certainly think that's something that, bankers are interested in, financial communities interested. And, so if there's some good news, at least if you're borrowing, we've got some low interest rates or refinancing that can help, kind of help make it a little bit more bearable these days. So with that, I'm just going to kind of say thank you. But if there's some questions, I'd be happy to try to address any of those. And then you've got my contact information here. I appreciate the time you've given me tonight, and really enjoyed the opportunity to spend some time with all of you in March and learn more about your organization and the great work that Amber and Michaela are doing for you. So thank you very much.
Thank you, Tom. I appreciate that. I'll start you off with a question that I have is, I've been talking to the Farm Service Agency, and, they're kind of saying, it's bad now, but we're going to really feel it in the consecutive years. How long do you think that we'll be feeling this COVID-19 hit?
One of the ways that I kind of look at that is I also have the opportunity to sit on an advisory committee advising the governor on revenues. And so we get to bring in somebody from agriculture, somebody from construction, somebody from services, somebody from, all these different sectors across the United States. And what we're kind of hearing there is it's going to be, 2 to 3 years or, revenues at the state level kind of recover. And I think that's probably not too far off from most industries, ag included. We've just got a big supply of stocks of certain commodities right now. And, we've got to work through that before we can get prices up. But there are some shining lights here. I think, agriculture saw some real shocks here when a couple of the big, large beef companies had to shut down because of worker health issues. But I think there's certainly a lot more interest now in some of the smaller custom processors to maybe become federally inspected, or maybe some of the smaller beef companies to try to expand their operations and create a little bit more diversity. And that may help our industry become less dependent on some of the big, large supply chains. And I think we're seeing a lot more direct to consumer that typically has a little higher price point for producers. The CSAs are doing well, farmers markets are doing well. It just tends to be some of the real commodity driven, segments of our ag economy that are really struggling right now. Unfortunately, they tend to be the lion's share of our industry too. So maybe we'll see a little diversification that can help bring us out of it a little sooner. But I think, it's going to be, the impacts of COVID. I think, the food companies have adapted well. Producers are doing well. They're working with their workers to make sure they're safe and healthy. And, I think it's just more the impacts of global markets that are impacting ag, perhaps more than COVID right now.
Thank you for that.